Frontier markets are smaller and less developed compared to their emerging market counterparts. In Asia, the MSCI classifies Bangladesh, Sri Lanka and Vietnam as frontier markets. Outside Asia, there are frontier markets in other regions, including Africa and the Middle East. Long forgotten by investors, frontier markets have lagged their emerging and developed market counterparts over the past 5 years.
And that's partly because there's been a number of issues with regard to liquidity more generally coming out of the markets. There's been issues around some of the commodity prices and the impact that's had on these economies, and just generally a perception of higher risk.
But these little guys have made a comeback so far this year. As of June 7th, the MSCI Frontier Markets Index is up 11.23%. Frontier market specialists see room for upside.
The demographics of these countries are phenomenal. We just see that as driving consumption and economic growth for many years to come.
In Asia, Vietnam has attracted strong interest.
It's one of the largest frontier markets today, and they are a beneficiary of some of the fallout of tension between the US and China in terms of the shift of manufacturing. They are doing some great things in terms of that growth of our industrial base, and certainly economic growth looks promising, and there's some really interesting companies.
These experts also see opportunities in frontier markets outside Asia.
If we do see a strong commodity recovery, then actually some of the African countries look quite interesting. And over the longer term, that's certainly where there perhaps are some of the greatest untapped opportunities in terms of people being less familiar with them. And more importantly, the economic development, demographic change is all very positive for areas like that.
They say the African story is not just about commodities, but technology as well.
Within the funds at Somerset Capital, we have almost 10% weight to technology companies. There are many exciting businesses in our universe. They're just not often included in the benchmark.
One example of an emerging tech play is Kenyan telecoms giant Safaricom.
That's a telco in Kenya, which is doing a great job of developing mobile money and actually allowing greater financial penetration outside of the traditional banking sector.
Safaricom is listed on the Nairobi Stock Exchange. Frontier specialists say the upside potential for prospective investors will come from the pipeline of more of such tech companies seeking to list. According to them, there are many more Safaricoms around in frontier markets, as these markets actually provide a conducive environment for the growth of tech and fintech.
You don't have the embedded infrastructure of legacy economy companies. Some of these startups and these young entrepreneurs find it easier to leapfrog and actually seize market opportunities.
However, before investors get too caught up in the excitement over frontier markets, they have to be aware of the risks.
When you look at frontier markets, they are less liquid, and therefore, as a result, getting in and out is harder. And you shouldn't necessarily be paying sort of valuations that you're paying in some of the emerging or developed markets.
Despite such risks, market watchers point out that these markets do provide benefits in a diversified portfolio, which includes developed and emerging market assets.
Because there's less foreign money in many of these frontier markets, they are less correlated with other markets, because typically when you see taper tantrums or any sort of risk-off events, foreign money leaves, and as a result, you can see big sell-offs.
What this means is that in a global market downturn or a major risk-off event, they won't fall as much as their peers, and hence the entire investment portfolio won't be hurt as badly. Aside from market-related risks, investors also need to be aware of internal governance challenges, such as unclear or constantly changing regulations.
If you look at the regulations as well as governance standards in the emerging market space or even frontier market, they generally trail those in developed market space.
Other market observers argue that poor governance is a stereotype that some investors hold of frontier markets.
It's just that sometimes the reporting standards are not perhaps what we expect or what you would get if you are investing in a company listed in New York or in Frankfurt or in London.
Governance is part of the ESG, or environmental, social and governance trend that has gained momentum since the COVID pandemic. Critics have raised concerns over the E and S too. These are the environmental and social issues such as human trafficking, child labour and women's rights in frontier markets. Frontier specialists say by incorporating ESG guidelines into the investment process, they hope to drive positive change among the government and corporates.
If we recall what the United Nations Sustainable Development Goal was set out to do, it is actually to elevate these poorer and developing countries into a better place, because we recognize that the vulnerabilities in these countries would actually eventually affect all of us. And this is where the whole idea of sustainable investment has come from. So there is real hope that as we go beyond this emergency action of the pandemic and we refocus on the massive inequalities and difficulties of these countries, and where we focus on trying to rebalance to a more sustainable economies, there could be real opportunities in some of these countries.
With the different risks and benefit considerations in mind, how is an investor to navigate these markets?
Given how localized some of these factors are, one may want to consider active related investings where there's a local presence to actually understand and navigate the ebbs and flows of what's happening to the corporations on the ground. But certainly if one wants to look at passive investing via ETF, that's also another avenue which is quite widely available to most investors out there.
Passive investing via ETFs or exchange-traded funds can work well if investors invest for the really long term, say around 20 years.